I've had a few friends and family members reach out to me recently asking what's the best way that I can invest for my kids or my grandkids' future. And as a financial planner, this just makes me so happy to hear. So thank you for even asking those questions. The earlier you get started with these things, the better. So in this video, I wanted to explain 3 different options that you have for investing for, again, a newborn child or a grandchild, and explain the pros and cons to each one, as well as some tax advantages and things like that, so that you can use that information to decide which is going to be best for your situation. Hey everyone, my name is Jake Skellhorn, certified financial planner with Spark Wealth Advisors, where we give you the confidence and clarity that you deserve with your money. Compound interest is a beautiful thing, and kids are the ones that stand to benefit the most from it. So just for example, if you were to invest $2,000 up front and just $100 a month for a newborn child, they would have over $50,000 by the time they're 18, assuming a 7% rate of return. If that contribution was $200 a month, it almost doubles to $93,000 or so by the time they're 18. So again, early and often is the theme when it comes to investing. There's 3 different types of accounts that you can invest for a minor. There's a 529 account, custodial Roth IRA, and a UTMA account, which stands for Uniform Transfer to Minors Act. And that's more of just a custodial brokerage account that we'll discuss last. First one is a 529 education savings account. Just like the name implies, the primary purpose of this account is for education expenses when the kid is of age. Some of the tax advantages to a 529 is that all of the interest, dividends, and capital gains inside the account are not taxed like they are in a regular investment account. So that allows your investments to continue compounding and growing more long term. There's no federal tax deduction to put money into a 529 account, but a lot of states do offer state tax deductions or credits depending on your state. So there could be potential tax savings there for the contributions, but just none on the federal level. And when you withdraw the money from a 529 account, as long as it's used for qualified educational expenses, all of that money, your contributions, the growth and earnings is all tax-free. So it's similar to a Roth IRA in that nature, as long as you use it for education expenses. Some of the common education expenses include tuition and fees, room and board, and books and supplies. Some of the not so common or not as well known, I should say, uses that you can have a 529 for are vocational or trade school, so it doesn't have to be a typical college or 4-year degree. The funds can also be used for apprenticeships, and up to $10,000 can be used from a 529 to pay for K through 12 schooling and paying off student loans. So the uses for 529 funds are pretty vast. It's not just for tuition, so you can use them for quite a bit. One of the only downsides to a 529 plan is if you withdraw that money for anything other than a qualified education expense, you'll have to pay income taxes and a 10% penalty on the growth. So make sure that you're not overfunding a 529 account. Make sure that you're trying to plan properly for exactly what you'll need, and hopefully not too much more. There's virtually no contribution limits to a 529 plan. Some states do limit you to a very high limit of $300,000 or so that you can contribute total to a 529. But if you exceed the annual exclusion for gifts, which is $18,000 per year per person in 2024, then you do have to file extra paperwork, and that money would eat into your lifetime exclusion amount for gift tax purposes. So again, if you plan to contribute more than $18,000 per year, just be mindful of that. Now, one thing to note is that with 529 plans, you are allowed to front load contributions, so you can do up to 5 years of contributions all at once. So if you wanted to contribute 5 times $18,000, which would be $90,000 all up front, you can do that without having to file any gift tax paperwork. And the benefit of that would be that a lump sum generally is going to grow more over time than contributing that money in 5 years. By the way, if you haven't already, just take a quick second to like and subscribe to the channel here to stay up to date on any future videos I post, and make sure to share this with a friend if you think they could benefit from it. The second type of account you can open for a kid or a grandkid is a custodial Roth IRA. If they're under 18 years of age, they can't open their own Roth IRA, so you as the adult would have to be the custodian of the account. But just like a regular Roth IRA, this is meant for retirement, so many, many years down the road. But the benefit of this is that you can contribute dollars for them as long as they have earned income. So a newborn child probably won't be able to contribute money to the account. So even if you have kids that are 10, 12 years old and you want to hire them under your business, as long as they're doing legitimate work for your business, you can pay them a salary. As long as it's earned income, you can contribute money to that custodial Roth IRA for them. So again, with Roth IRAs, there's no tax deduction up front, but all of that money grows tax-free. As long as they withdraw it after age 59 and a half, all of that money is not subject to taxes either. For 2024, the annual contribution limit to a custodial Roth IRA is the lesser of $7,000 or the child's earned income. So if they earned, let's say, $3,000 for the year, you'd only be able to contribute up to $3,000. And another thing that's important to note is that you can contribute money for them as long as they have the earned income. They don't actually have to take the money out of their own bank account and put it into the Roth IRA. They just have to, again, show that earned income for the year. Just like a regular Roth IRA, the contribution amounts can be taken out anytime tax-free before age 59 and a half. And there are certain exceptions where you can take out the earnings penalty-free, but they would still be subject to taxes. So things like a first-time home purchase, qualified education expenses if you don't have enough in your 529. But again, the main purpose of the custodial Roth IRA is a retirement account. So teach your kids the importance of long-term investing and really trying not to touch that money, because compound interest, again, will be a huge benefit to them by the time they're 59 and a half. The third type of account you can open for a kid or a grandkid is called a UTMA account, or it's commonly just called a custodial account. And this is essentially a regular taxable brokerage account where you as the adult are the custodian and they're the beneficiary of the funds. Once they turn 18, anywhere between 18 and 25, depending on the state, that account becomes theirs and only theirs. So at that point, they can do whatever they want with the money, which could be a pro and a con. You know, there's no limitations like 529s or Roth IRAs have on the use for the funds or when you use the funds. But at that point, again, they can use the money on whatever they want. So you have no more say or control over that account after it becomes theirs. So just be mindful of that. With a UTMA, there's no contribution limits. There's no income limitations or anything like that. So there's really no tax advantages to it for that reason either. So you will pay income taxes on the dividends and interest and capital gains while it's in the account. So something to be mindful of. With the Roth IRA and the 529, those are tax advantaged. So all that money stays in the account and no taxes are owed on those. But that's kind of the price you pay with the UTMA for the added flexibility on when you can use the funds or when your child can use the funds without penalty. You do have to pay taxes along the way, essentially. Similar to 529 accounts, there's no contribution limits like we said, but anything over $18,000 per year in 2024 is going to be considered a gift to the child or grandchild. So you will have to file extra paperwork if you go over that limit, and it will eat into your lifetime exclusion for gift tax purposes. So just to recap, the 529 account is going to be best used for education expenses later on. The custodial Roth IRA is going to be best to kickstart your child or grandchild's retirement savings. And the UTMA account is the most flexible account. Less tax advantages, but that money, again, can be used for anything well before retirement if they don't want to go to college, whatever it might be. And lastly, it's really important to note that you don't have to pick one of these three. You can actually have all three of these in conjunction with each other. So each one is designed for a different purpose, but you don't have to pick just one. So remember that you can have each account contribute a little bit to each one. That way you have additional flexibility as well. So that's a quick recap on the three options. If you have any questions, I'd love to hear them in the comments below, and thanks for watching.